Hi, this is Bennett Tchaikovsky, and welcome to Standard Costing Part 2, which we're going to be going over labor variances. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to the Irvine Valley College, the South Orange County Community College District, or Chapman University. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright in 2008 to 2019 by Bennett Tchaikovsky. I encourage you to share this presentation and share links to this presentation on an unmodified basis. If you modify the presentation in any way, please email me prior to doing so at 1812cpa@gmail.com to discuss. Note, the author does not claim any copyright whatsoever in any of the companies or organizations mentioned in this presentation. Rather, the other parties are the owners of their respective copyrights. Okay, so we were talking a little bit before. We went through direct materials. This is now we're going to be focused here on direct labor. So when we're going through and creating a unit of product, what we want to go through and do is establish what are the labor standards to make one unit of product. Remember, for a manufacturer, there's really going to be four inputs. There's going to be direct materials, direct labor, variable overhead, and then fixed overhead when it comes to coming through with producing a unit. So with labor, what we're trying to figure out is what do we think it's going to take in terms of direct labor hours in order for us to go through and produce one unit of product. So what we're going to do is we're going to see what we actually spent on the labor in terms of how much did we actually pay in terms of labor to produce our units. And then we're going to compare that to the standards that we've set up. And again, if we've spent more, that's not good. It's going to be unfavorable. If we spent less, that will be a favorable variance. So when we go through here in terms of looking at what can cause direct labor variances, you can have unskilled or untrained labor. Okay, so you have workers that don't know what they're doing, poor management, poor supervisions, meaning that the workers are working unsupervised. You can also have if people are working overtime. Why is it overtime going to affect the labor variances? Because you're going to be increasing the rate. In California, after 8 hours, you're being paid time and a half. After 12 hours, it's double time. You could also have equipment issues. If equipment's failing and my labor is hanging around and they're not essentially, going through and aren't able to go through and do working, then that can also be a problem. Also, too, if there's other types of different worker issues, if your workers went to the Coachella and they had too good of a time and they're coming back into an accounting class and they're not going to be as productive. At the same time, too, you can have workers that are maybe even more productive. Like maybe I was fortunate in one of my classes where some Red Bull representatives started coming and hanging around and started giving all my students Red Bull, Yerba, some other kind of great caffeinated products. So it's good stuff. So here we're going to have Jail Lori again. They're manufacturing crew boats that are used by universities. Now, we looked at materials before, but now we're looking at the labor. And to manufacture a boat, it's going to require 35 hours of direct labor at a cost of $20 per hour. And it tells us here, so that's going to be our standard, right? So during January, we manufactured 400 boats that required 13,800 hours of direct labor at a total cost of $289,800. So the first thing we need to do in variance problems is we need to compute the total variance. Then similar to direct materials, we're going to go down and we'll break down those variances. So right here, so I'm going to go here. So we've got here, so here's our problem, and then here's where we're going to go through and work our solution. So in terms of what we actually spent, right? So we're doing the same thing that we did with materials, except now we're doing it with labor. So the total amount of cost we spent on labor was $289,800. So that was the total cost in terms of we actually spent on labor of manufacturing 400 crew boats. Now the actual hours we spent were 13,800. These are the actual hours we spent. Remember, we're comparing what we actually spent to the labor standards. So here, if I spent 13,800 hours for a total cost of $289,800, that must mean my actual rate must have been right here, $289,800 divided by 13,800, or $21. So how did I get this? It was $289,800 divided by 13,800. So the next thing I'm going to do here is saying, well, how much should we have spent to make 400 crew boats, or to make 400 boats, how many hours should we have spent? Now I know that my direct labor cost, or my standard rate, is going to be $20 per hour because that was my standard. But here, how many hours would it have taken me to essentially produce 400 boats? So I'm going to take 400, which is the number of boats that I'm doing here, and it's going to be 35 hours per boat. So 400 boats times 35 hours per boat is going to give me 14,000 hours. So that's how many hours it would take me to make 400 boats. This is my standard. This is what I am expecting this to actually have taken me. So when I take the standard hours times the standard rate, I'm coming up here with a total of $280,000. So to make 400 boats, I should have spent $280,000, but instead I spent more. I spent $289,800. So what I'm going to do here is my total variance, which is going to be $289,800, which again is my actual hours times my actual rate. And I'm going to subtract $280,000, which is what I should have spent. And that variance here is going to be $9,800. And this here is going to be unfavorable total variance. We spent more on labor than we should have. So again, I'm taking the standard, meaning what did I budget? If I was going to make 400 boats, how much should I have been spending in labor? I'm going to compare this to what I actually went through and spent. So that's going to be the first part of our problem. Now, similar over here to the other questions we were looking at previously. There we go. And go ahead and do a little present. And we'll see here. By the way, my computer's old. Google Sheets is awesome. Absolutely love this product. Absolutely amazing. So we've determined the overall variance. But now what we're going to do here, so we've determined the overall variance is right over here at, so our total overall variance is right here at $8,000, so $9,800, right? Unfavorable. So now what we're going to do, and this again is going to be similar to what we kind of did in the materials problem, which in this case is we're going to put the actual hours times the standard rate here in the middle. And we're going to get actual hours times standard rate. Now, by putting this middle value in, what we're going to be able to do is we're going to be able to isolate the cause of the total variance. Now, over here, because on this part I'm leaving the hours constant and I'm focusing on the rate of labor per hour we're paying, this would be called my rate variance, okay? So this here is the rate variance. In materials, we call it pricing, and labor, we call it a rate variance. Now, on the other side of this, I'm keeping my rate constant, and so I'm focusing on the hours. And here, when I'm comparing these two values, this is focusing on how many hours did I actually spend, or what we call, instead of a quantity variance, we're going to call this an efficiency variance. How efficient were we in going through and making those particular units? So again, actual hours times the standard rate, comparing that to the standard hours times the standard rate, this is giving me my efficiency variance. And again, what's important is when we add up these two different variances, that needs to equal the total overall variance. So now what I'm going to do is I'm going to go to my next slide right here. And I've got over here, wow, Tchaikovsky, you're actually prepared. So I've got actual hours, standard rate, my actual hours times my standard rate. So here, what I'm going to go through and do is make this little chart. So my so my actual hours were 13,800. My standard rate was 20. So over here, I have my actual hours times my standard rate is 276,000. So the first thing I'm going to do is I'm going to compare to get to my rate variance. What I'm going to do is I'm going to compare here. So my rate variance is going to be the actual hours times the actual rate less the actual hours times the standard rate. And this is going to give me my rate variance, or 289,800 minus 276,000. So this here is going to be 289,800 minus 276, or 13,800. Now note here, intuitively, my actual rate was $21 per hour. My standard, though, was $20 per hour. So I'm paying more on an hourly basis. So this is going to be unfavorable. Rate variance. My rate per labor hour was higher than budgeted, or my standard, or it's higher than the standard rate. Okay, so it's going to be unfavorable. Most of the time, the instructors will only want you to go through and to say, is it favorable or unfavorable? But what I'm more interested in with you is to really kind of go through and understand it, right? How do I know if it's favorable or unfavorable? Well, if I actually paid more than what I was budgeting for, that's why it's here. And again, I can do this here because I'm leaving the hours constant. It's my rate that I'm isolating. The second part of this is my efficiency variance, or what we would call in materials, we would call it a quantity variance, but here it's going to be an efficiency variance. Meaning how efficient were we in actually going through and producing the units of product. So this is going to be my actual hours times my standard rate minus my standard hours times my standard rate. And here, this is going to be a negative 4,000. And this is actually going to be favorable. Why is this going to be favorable? Because I only spent 13,800 hours making 400 units when I should have actually spent 14,000 hours making those 400 units. So when I add up my rate variance plus my efficiency variance, I need to get to my total variance. And so here we're saying 13,800 minus 4,000 is going to give us 9,800. So I know that this here works. Okay, so that's how we go through and we further go down and isolate these variances. So now what I want to go back and kind of look at is like what's really causing these different variances. And again, it can be overtime, right? I was paying $21 per hour, but I was only supposed to be doing 20. So maybe I was paying higher rates to certain workers. I don't know. Could be poor management or supervision, unskilled or untrained labor. Could also be equipment issues. Remember, going back to the first video, our process here was we want to talk, we're not experts on everything as accountants. We want to go through and talk to our production supervisors so we get an understanding in terms of how to make those standard costs. Once we have those standard costs and we're comparing them to the actual, it's going to be up to us to continue to ask those questions and further refine our process so we understand what is going through and causing these variances. And I want to really emphasize again how important this is. If I'm selling my product for a fixed price, and if all of a sudden my labor, my materials, or my overhead costs go way up, and I need to have a certain gross margin, meaning my sales price minus my cost of goods sold, and my cost of producing these units is going way up, then I'm going to have a problem. So again, I want to thank you for joining me here in this cost accounting journey. Please don't forget to like and subscribe, and I will see you in the next financial or managerial accounting video. Have a great one.